the devil's in the details with this particular asset class. Nobody likes to track data. Nobody likes to track documentation. Chaos makes everyone reevaluate what we're doing. And I think that's just a healthy thing to happen. There's billions of dollars of safes out there, and those don't have to convert ever. It's really hard to nail down a right process, like a right best practices of doing any of this. Every single person is using something different. The whole project is not getting the data in the system, it's finding the data is the problem. So if you're an investor, an angel, a VC, please track your data. Please just start tracking it.
Welcome to The Diligent Observer, the first podcast exclusively focused on helping angels see what others miss. I'm your host, Andrew, and every week we explore what works, what doesn't, and why through conversations with experienced startup investors and operators.
My guest today is Alycia Doxon, CEO of Seraf, an investment management platform used by angel networks, family offices, and venture funds across the country. In this episode, we explore the ongoing reset in venture markets, how angel networks may evolve in response to lengthy holding periods and infrequent liquidity events, and why data tracking is perhaps the most overlooked aspect of portfolio management, with many investors unable to even locate their core investment documents. I hope you enjoy learning from Alycia as much as I did. One quick note before we jump in. If you're an angel investor or thinking about becoming one, you need to know about the Angel Capital Association. The ACA is an incredible community for connecting with experienced investors, tapping into tons of well-documented best practices and training resources, and just generally keeping up to speed with what's happening in the angel space. Now, I've really enjoyed getting connected over the last few years, and that's why I'm so excited to partner with the ACA to bring you this special series of episodes live from their annual summit in Denver. If you're serious about angel investing, you will definitely want to check them out. Alycia, thank you for being with me today.
It is my pleasure. I've been thinking about this for a week.
Wonderful. Well, we are live here at the Angel Capital Association event in Denver, Colorado. This is day 3, and so we have had a lot of presentations, networking. We're all exhausted, but thrilled to be here. And so, Alycia, I am excited to hear about you, about your work, and just to learn from you, because I think the product that you all offer to the market is so beneficial to so many individual angels, funds, just the whole ecosystem benefits because of the work that you do. So thanks for coming on today. My first question is, what are you excited about right now?
I think me being me, I am most excited about the shakeup that's happening here. And it's a little bit counter to what I should be hoping for, just given it's shaking up what our company, like our sales are going up and down and things like very weird things are happening from a company standpoint. But I think that the venture markets are resetting themselves to a certain extent, and that every once in a while, investors and founders need to be reminded that profitability and cash flow is important, and that government subsidy of medical device doesn't always have to be there. And so, like, if you're doing things that are not necessarily profitable inherently, then you need to consider how to commercialize that in a way that is not being done right now, because everybody's relying on like millions of dollars of grant funding. And I just generally, I like the shakeup that's happening, because it's not something, there was like a spike in venture investment in 2021. And then 2022 was like back in the slums. 2023 and 24, people were like, okay, we're a little bit optimistic. And now 2025, people are like, no, like rake it back in, right? Because everyone's in that level of like chaos makes everyone reevaluate what we're doing. And I think that's just a healthy thing to happen. So that is what I'm excited about, because I think there's a lot of different models and perspectives and learnings that's going to come out of this period. And so for me, just my personality, I really enjoy it, thrive on the chaos.
Say a little bit more about some of these themes that you think will emerge from this season. You mentioned that there's some learnings that are starting to happen. And we're evolving a little bit. What are those key themes in your mind?
Yeah. Okay. So even during this conference, the last 3 days, so the first day there was a keynote, and the main takeaway there was like, don't panic. I don't know if you had that one at
Ron Weissman.
Yes, is don't panic, right? Which is a great standard. On the second day, so I don't know who the speaker was, but again, a keynote, and she was like, well, we really need to bear hug our founders and be supportive investors, invest more capital if you have to. And also, I generally agree, that's a great methodology. And then today I was at a session with Kretsu Forum, and Kretsu Forum's approach is like, I don't want to say aggressive, but be an activist. So they like redid their model recently to be more activist investors. And so they're looking at companies and saying, I want a board seat, and then replacing the CEOs with their own CEOs if you've hit a rut, and trying to like really force their portfolio towards exits because they're trying to push back towards getting liquidity because everyone's kind of got a crunch. And so the responses to the environment, I think, are really interesting in the way that people are going about continuing to support their startups, or well, support them in a different way. I want to say, or not. It's just some kind of support, because you can like support and you can mentor and you can try to make those connections without taking over the company. To do that, there's frustration and everyone's kind of tired of waiting for exits right now. And so I think those are some of the things, like the model of angel investing too, in that when you haven't seen exits for so long, and then the group members start to trickle off, and then you find out like it does this model of angel groups, angel networks as it stands, does that actually work? And I think that is a question to ask, because they've been around for 20-ish years now. And I think it's somewhat time to like, and again, why I'm excited is like, it's an evaluation, it's like a reevaluation point of that model. Does it make sense to not set up SPVs? Does it make sense to have volunteers running groups? Does it make sense to like be sticking your whole portfolio on one strong exit to return the capital and then some? And so I think it's really just, there are some of those learnings that are starting to rear their heads, which is great. But I think by like Q2, end of Q2, Q3, depending on what the market does, you may see a reformatting of like how the angel groups actually work and how it functions.
Well, I certainly agree. I mean, being in the trenches, helping run a couple of different communities, I mean, we see a significant amount of reevaluation across an individual's portfolio. We talked at the conference about this denominator effect, where the total exposure to early stage venture, when the public portfolio drops precipitously, actually increases. And so an angel could go from having 5 or 10% exposure to 14 or 20% overnight. I want to do a thought exercise with you, and I'm curious, as you think about the world of angel investing in 5 years, what looks different? What's changed? What are the things that, if we continue on this course and we continue to more thoughtfully evolve in response to this current economic situation, which is new and different, what does angel investing look like in 5 years that's different from how it looks today?
I think that I have a little bit more of a pessimistic answer for you, in that the capital is starting to consolidate quite a bit. And it was already concentrated to Silicon Valley, New York, like certain hubs. But at this point, we are 50% concentrated to AI companies, quote unquote. And the biggest AI company is going to be like the one that's eating all of that capital. It's already starting to happen. And I think the consolidation of that is going to be in Silicon Valley, or wherever the center would be in China, or like those are different centers kind of. And so I think the angels largely are going to lose out on strong returning deals. And so the model is going to have to change. I don't see how we can, right now the groups are trying to like, the credit reform that I mentioned, like they're trying to manufacture returns. And that is what the people in Silicon Valley are able to do on a very regular basis, right? Because they've got a lot of capital, they can funnel it, IPO, and then the public market takes a, like this. If you look at the stock after they IPO, it's like drop right back down, right? You're excited, and now we have foisted it on the public. Sure. And so I think the opportunity to invest in companies that will eventually exit for a strong multiple for angels, that opportunity is going to keep dwindling and dwindling unless there's like a refocus to the centers where the AI technology is being massively deployed and funded. And I think that also with 5 years from now, we're like out of the current administration. I know the grant funding and the NIH funding is huge for all the healthcare companies, the ones that are in the Carolinas.
Sure.
And
well, we've got 7 or 10 healthcare companies here at ACA sponsored or supported by the NIH programs.
Yeah. Well, I was astounded at their presentations that they're like, so our total round is 10 million, but we've raised 5 million in non-dilutive funding. And I'm like, the government gave you $5 million is what you're saying. And it's the taxpayer that's funding the innovation for you then to commercialize, and make money off of. And then does the taxpayer necessarily benefit from that? Like, yes, if I get this very unique, well, it depends on the technology, right?
Sure, sure.
But I think in this current administration, a lot of that might be clawed back. And so 5 years from now, we'll be back in the other swing, ideally, unless we get a third term.
So this is an interesting concept. And I think the massive pooling of capital around AI over the last year, I mean, it's just like 50%, you have the numbers.
Yeah, it was 51% in 2024. And then Q1, I got that stat from the first keynote, like 50% of the capital that was deployed into OpenAI in Q1. And that's why the numbers, otherwise it's like AI is inflating. Like I think we're in a slump. We're certainly in a slump. Everybody can feel that, but the numbers don't reflect it as heavily as they would if we did not have all these millions of dollars being billions of dollars actually at this point being funneled into quote unquote AI companies, which is also not the development of new AI structures and new LLMs. It's like companies who are utilizing the same AI to apply to like different niche, like new AI marketing tool, fills, SDRs. Like that's kind of what's being funded right now, in my opinion.
Well, and I think the regional element that you touched on is interesting as well, because I think there's also a trend or a story, especially since COVID, of no. You can build these great companies outside of Silicon Valley. You're not trapped here anymore. We have this new technology, and so you can
Yeah.
build anywhere. And so we see this emergence of more rural entrepreneurship ecosystems and cities that never would have thought about this before, and they would have just traditionally focused on small business development, are now thinking about how do we support startup development in our ecosystem. And there's several investor communities here today representing this kind of a background. And so how do you think this tension between kind of the, I don't know, the diaspora of entrepreneurship paired with this re-aggregation that you're pointing towards, how do you see those like working in tandem over the next few years?
So I don't know if they're going to work in tandem. And there is a reason that things consolidate in certain places, and that's because the people are there. And so with COVID, it was like, oh, everything can be remote. And as angels started investing farther away from home, but the reason that we're all here in person at this conference is because that's where the most impact is made. And I think that if the technology centers are consolidated in certain places, it's all going to gravitate back to those places because that's where the human bodies are. Like no matter what you say about remote work and what you can do remotely, like you can do things. But if you're raising funding, like as a startup, you're still, to do it effectively, going on a little bit of a roadshow because you have to meet people in person and there's still a lack of trust. You could say millennials might be a little bit more trusting via Zoom meeting or a phone call. No, we don't have phone calls, but Zoom meeting.
Nobody
But
does phone calls anymore.
phone calls. But the boomers, right? The people who are angels, are actually angels and deploying capital, are not necessarily comfortable with that. I think that we had a swap at COVID that it was all generally acceptable. I think it's going to revert to you got to be in the room or around the room. And if the room is like only in Silicon Valley, because that's where all the capital is and that's where people who are developing and basing their headquarters with the technology, I think the best move, in my opinion, I just think that is, I don't know how it's going to jive with the rest of the country. I don't know.
I think it makes a lot of sense, and time will tell, right? If this continues or if there is.
Yeah, I'll find this in 5 years and be like,
I mean, there could be another pandemic. There could be any number of things could happen that could affect this.
well, and people are optimistic. And I think the work that people are doing to facilitate investment in startups that are in non-traditional locations is wonderful. My undergrad was in Milwaukee and they have a small but really tight knit startup community there that I loved. Even now, I still reach back to my contacts that I made there because the startup community was so tight and so supportive. And I think that is wonderful. But if you're looking for a 100x return kind of company, it's hard to find. I think they're kind of hard to find outside of the centers, and the centers are going to be where the people are. So
totally makes sense.
yeah.
Okay, so let's move on to a little bit more about you. I mean, for those of our listeners that aren't familiar with the Seraf platform, I'd love to hear more about the current state of the product, what you guys offer, what you do, who uses your product. And then I'd love you to just tell the story of a company and how you got involved, because I think this is a really interesting evolution of the product and of the company. And so walk us through a quick overview of what Seraf is for those of us who may not be familiar, and then your story and how the company got to where it is today.
Yeah. So Seraf is a deal flow and portfolio management software for early stage investors. Primarily, originally it was early stage investors. We have since expanded to kind of all private market investors. And so we have individual angel investors, angel groups, venture funds, and family offices are our customer base pretty much at this point. And the tool was built by two guys that were actually heavily involved with the ACA, Christopher and Ham, who you probably know at this point, and a lot of people actually probably know. They founded the company in 2014 and then started commercializing it, and then built out originally it was just for their angel group, Launchpad venture group, and then started commercializing for funds, and then rolled out the deal flow add-on. And then in 2023, mid-July-ish, sold the company to me. And so now I own it and run it. And that was actually, have you heard of search funds?
I have, but for those
Most
of us
people.
maybe that haven't, what is search funds?
Okay, so search funds is like an MBA phenomenon where MBAs, it's other people too, but primarily MBAs, they're going to the MBA program, typically the higher level schools. So like Harvard, Yale, Wharton, Oxford, where I went for my MBA, has a focus on search funds. And you are more or less pooling investor capital to then go acquire a company and then take over that company as CEO. So you're buying your way into a CEO seat, and it's entrepreneurship through acquisition, quote unquote, is the term that you would be looking for. So when I was doing my MBA, I either wanted to found a company or acquire a company because I was just kind of, before that, I had worked in a couple different high growth tech companies. As a CEO of a company, we raised 27 million or so and then scaled nationally and did the whole thing. And then I was like, I'm tired of this. And so went to do my MBA. And basically, I was like, I need an
Get me
English
out.
vacation. Yes. But and then it wasn't that. So I went to do my MBA and then I found the opportunity to acquire Seraf before I had an idea that I thought was like venture backable or worthy of doing at that time. So I bought it not via search funds, but the search fund was like the model under which I learned about all of this kind of stuff in terms of acquiring businesses. So I acquired Seraf via a holding company called Harriet Ventures. And Harriet Ventures is going to be a multi-acquisition kind of company. Most search funds are just like one entrepreneur, maybe two. They raise one fund and then they acquire one company. And then they scale that and eventually try to flip it, sell it, whatever. And that's not the model that I wanted to employ just because I'm a multifaceted person. And so I wanted to acquire multiple companies under a holding company and then either do bolt-ons, which is kind of half what we're looking at Seraf right now, or just continue to acquire companies that complement each other in the portfolio and grow that as a portfolio of cash flowing profitable companies. So that is my background and how I got here. When I was looking for something to buy as far as companies go, I really wanted to be in the entrepreneurship ecosystem. And you're very limited on things that you could like feasibly buy, especially because a lot of companies in the space, software companies, they're raising funding. And very quickly, I found that the private equity valuation that I would probably come in at is very different than the venture valuations. And it's hard to find common ground when like you have a founder who's raised $1 million or $2 million at like a $10 or $20 million valuation. And I'm like, this supports no cash, no debt service at all. So I can't really do anything with it. And so anyway, I found Seraf. We're doing great, we're profitable. And that's the story there.
And so talk about some of your vision for evolving the company. Chris and Ham built a fantastic product, and many of the communities here rely on heavily for portfolio tracking, monitoring, and more. I know you're working with a lot of venture funds as well, but the Angels ecosystem in many ways is leveraging the work that they have done and you have continued. What is your vision for the company? Like, where do you see kind of growth here? And specifically, maybe for the Angels segment, how do you see the future of Seraf evolving?
That's a great question. And that's the constant struggle.
Constant
like,
question, right?
like,
Yeah.
like, where do you resource allocation, right? Where are we allocating resources to develop the product? And so our biggest thing right now is I am really probably too influenced by my own biases, and I am an operator first. So coming from the COO seat, have done a lot growing teams, scaling teams, just like managing KPIs, managing how companies run. And I think that our tool right now, I want to take it in the direction of an operations tool. Right now, you can track your deal flow to a certain extent. It's not anything fancy, right? It's like got bells and whistles on it. Like it's effective, but it's not fancy. I think that there's a lot you could do with deal flow in that you can bring in, like you can do, what I really want to do is like build an overlay for email that you can take inbound and you can take applications, because right now the inbound is like, so even I get emails like with Harriet Ventures, they're like, we're raising funding for XYZ. And I'm like, I don't want to do this because I can't. But also I think those are worth, depending on the case, like could be worth looking at. I know it's not traditional to the angel investment space to look at cold emails, but I don't think you should discard them. So there's that part. But also the core software to manage your portfolio, we're going to build out a portfolio monitor, which is going to scrape the internet for updates, because I've talked to a lot of our angel group customers and it's a really hard thing for them. I'm sure you see it too. Just monitoring, like getting updates is one thing. And then if you don't get updates, what do you do? If you don't have a board seat, if you don't have information rights, like what do you do with that?
Oh, you get amazing information when you're about to close. You get tons of updates.
Yeah.
You get everything.
Yeah.
The entrepreneur is so responsive and
Yes.
engaged, and that's for sure going to continue. But
And then after
after the close,
well, It's also, I've been on the founding side of things, and founders stop communicating when things go bad. And it's like one of those really hard, like, I cannot stress enough that if there's like a founder and you're having a down quarter, year, whatever, like you need to over communicate.
Yeah.
And
Yeah.
you might get beat up for that a little bit, honestly, because it's never fun. And it's always like emotionally draining to
Yep.
communicate bad updates. But it's one of those things that as soon as you start having a bad time, founders just, they pull back and they don't want to talk to anyone. And that is the opposite thing that you should be doing. Anyway, all that to say, a portfolio monitor, I think, is going to be a way for you, like, at the very least, to pull in information from like LinkedIn, from news articles. Like, is headcount going up or down in the last 60 days? Is this company alive? Are they posting on LinkedIn? Is the founder posting on LinkedIn? Is it just completely dead in the water? They're a zombie. Like,
Yeah.
I think a lot of this information, you can find it now, but you still have to go pull it as a
Right.
group manager, as someone who cares. And so I'm interested in doing that, building out what our the monitoring functions look like. And then from there, there's always the AI discussion of what you want to do or don't want to do with AI. That's a difficult one because people want to be able to monitor or model out. They want to see the insights from the companies first. And so first you need the data, right? Is our sales going up or down? Where's your churn at? What's your CAC? So you need the data first, which most people don't. And then you need to apply the data to that investment in that particular industry and say, is this going to go, like, overall, what's going to happen here? I think there's a push to go in that direction, but I think the underlying data is probably not there to be able to do that, especially because as an angel, you're so early that if you get to Series A or Series B, you don't have a lot of insight. So you're seeing what comes in from TechCrunch when they raise their next round, and that's helpful, but it's not really that helpful in terms of feeding into a model that says, with a mass amount of data, you could do it. And so we would have to pull from external sources like LinkedIn with PitchBook, LinkedIn with Crunchbase, all of those kinds of things. But I think people really want to be able to look at and be able to pick and choose, what do I double down on based on the data that's in the system? And I think we're probably a little bit far from being able to actually do that effectively. Although that's something that I think would be greatly useful for the ecosystem. So anyway, AI considerations, both in reporting, pulling out insights from portfolio companies, trying to scrape the internet and say, hey, the headcount is down by 50%, something's happening here. Like we should look at it. So, and trying to make it like a more actionable tool than what it is now, because my bias is towards action, right? My bias
More
is towards
predictive, preventative reaction to what's
Yeah.
happening versus, oh, yeah, you're right. I haven't heard from this company in 7 years.
Yeah. Things, and honestly, we have onboarded investors that have 15-year-old portfolios, and as an offering, we have data migration projects that we can do on behalf of investors. And so we literally reach out to all of the investments, and like it's all email kickback, but they never knew. They just, or they saw at some point an email that we're dissolving, and they never updated that in their spreadsheet. At a minimum, I think that if we could get to a place where all the angels know what's happening in their portfolio with each company, we'd be in a great spot. And I think we're like not close to that right now.
I love the fact that you're working on this, Alycia, because this is such a need in this space, and your customer base is showing that. But it's one that so many angels just struggle with, because this is a small part of their portfolio. It's 5, maybe 10% of their portfolio, well, maybe 14%, depending on the denominator effect of what's happening in the public portfolios. But it's intended to be a small piece of their portfolio. And then to do it well, you've got to split that into 10, 20, 30 deals, and then you've got to track each of those. And so it's just this diminishing return on effort for the angel to actually go out and pull that information. And so the fact that you're building tools to make that easier is so valuable.
Yeah. Well, and it's so difficult because the public market's just like up and down every day, right? So there's always something to look at. There's always dopamine.
Yep.
Whereas the private markets, in startups or not, it just like, it's a slow moving beast. And so your exit is like 7 to 10 years. And 10 years from now, I can't imagine, I'm 29. If I invest in a company now and then I'm about to be 40, like that's a very long decade to wait and try to continue to think about what's happening here. And so like, it's just, by nature, the asset class is like a very long-term horizon. And that's hard to convince people that it's important to stay on top of it, but it really is, especially at the angel level. So
when it's interesting to even think about the contrast, right? Because it's a super intimate decision-making process. As I get to know you, I'm spending time with you. I'm having lunch with you. I'm digesting all of your financials and your background. You're still like, I spend a ton of time, if I'm doing it well, getting to know you and making this decision with confidence in you in many cases as a founder. And then theoretically, in the good investments, I stay involved. I'm helping. I'm contributing. We're touching base. We maintain that relationship as the company grows. But that's not always the case. That's the good ones, right? When it's done the right way with the investor that has the right mindset and the founder that also has the right mindset. But in so many situations, that intimate kind of investment process happens, and it's super fulfilling to hand that check to you. It's like, go,
Yeah.
go do. I'm here. We'll be with you in this. We can go and do. I trust you. And then they go, and it's okay. It's been a year. Okay, it's been 2 years. Okay, it's been 5. Okay, it's been 10. And that decision you made 10 years ago, it's so contrasting
Yeah.
to think about.
I truly think that if you're angel investing, you have to make a concerted effort to not expect it all to fail. Expect it all to go to zero. And if you're okay with that, make the investment. I think there's too big of a lack of data to like tout this as a high return asset class, in my opinion. And that's because I've seen a lot of varying data. And behind the scenes, like we can't be specific with that. But if you look from angel group to angel group, or if you look at like pitch book reports and things like that, you see that top 50, okay, fine, they did great. But you'll notice where they're located and the kinds of companies that they're investing in, and the fact that when they invest, they have follow-on ready to continue to funnel that growth forward. So they pick, right? Because there was 3 or 4 Ubers, but Uber was the one that was chosen. And then Uber was fueled forward. And so I'm not saying it's a conspiracy, but it's something to think about, that the data is lacking. And so that adds to the risk of the investment that's already risky in the data that we do have.
So you've clearly been very thoughtful about your approach to getting into the space. You've been in this business for a year and a half. Tell me some of the insights or some of the things that have surprised you or that you've discovered over the last year and a half working in the space, working with angels and other early stage investors, coming from the operator's background, going through the MBA process, and now entering into this side of the equation as a operator, in a sense, of a platform business that many of our investors are relying on. Share some of the insights or the things that you didn't expect that have become very clear to you over the last year and a half.
Right after we took over, Pegasus Venture Group, one of his like 10 secrets of investing was that investors largely invest based on gut feeling. They're not necessarily using their brains to like crunch numbers and do things. That was one of the first things that I found when I took over and went to the first conference in Orlando. I went to a venture conference in Orlando, and there was a VC panel, and they were talking about how do you analyze and then value deals, and how are you doing your diligence? Like, what metrics are you looking for? And he's like, well, warm intros and gut feeling. But they were a huge fund, right? They got like a $75 million fund, and they had SSBCI money that they were deploying for the state to double that amount. But then that became a trend. And what I kept and keep seeing is that a lot of this, because it's people to people based, and people are trying to, I think that is just naturally like how humans de-risk anything, is like, if I could see you face to face, look in your eyes, I feel a lot better about what I'm doing. It's one of the things I didn't necessarily, I thought it was a little bit more methodical than it is. So that was the first one. The next one would probably be the mess of the behind the scenes that I also didn't expect. Yeah. So the other thing that I came across was the mess of the behind the scenes, not just for angel groups, but angel groups, venture funds, family offices. Nobody likes to track data. Nobody likes to track documentation. It's the boring job that nobody wants to do.
Yeah.
And so when we're trying to onboard a family office with 10 years of investment history in venture funds and startups and private equity funds, the whole project is not getting the data in the system, it's finding the data is the problem. I was very surprised at the large number of funds and angel groups that don't have data or have to go track the data. I'm particularly appalled with, well, not anymore, but I was with the funds, because the funds are taking LP capital. And so I look at it from the standpoint of like, that's not my money, but I've taken on $10 million for my new fund, and I didn't have the decency to track the investment documents. I wouldn't dare take on capital of someone else's and then not know where my documents are, or like not know how much this investment was and what year, what day it actually took place, and those kinds of things behind the scenes. That was like, yeah, it was appalling to me when I first started.
So, okay. So on that
what is
point,
happening?
You're talking to a new investor who's considering a fund. Give me like 1 or 2 questions that maybe most people aren't asking that you would encourage one to ask if I'm considering becoming an LP in a fund, to kind of suss out the type of thing.
Okay, first thing is probably like where you're doing your admin and accounting, which is a stupid question to have to ask, but you have to ask it because I think there's a lot of risk with doing that internally. Some people do. Like, I actually talked to a number of people with angel funds here that do that in-house. And that is like a huge strain on the person doing it, that's actually deploying the capital and in charge of the capital calls, capital commitments, all of that. is very difficult to manage. And there are firms that do this fairly well, not Carta, but like other ones that do it actually really well. And so I think that's a question that I would ask. I would also ask about reporting, in that I think GPs do a bit better than if you were making an investment into a company. GPs have a duty to, like, fiduciary duty. So that's great. But I would certainly ask about like the frequency of that, the format in which this is coming, because our tool has an LP portal. And I found that like it's a nice to have, but you have maybe 20% of LPs that actually log in and see things. When I poll people and like who's using the LP tool or not, you have some people who are like very active, but that's a minority of your LP group. As an LP, that would be something that if it were me, I would be curious about. And I'm a very hands-on, very active person, so that's why. Other things that I would probably ask, how you're dealing with follow-on strategy. In terms of a VC strategy, I think the money is in the follow-on, and the allocation of your portfolio is something that's really important and not necessarily underthought, but like not as flashy as like we're raising a $50 million fund to invest in ag tech or underrepresented founders or whatever that happens to be. But like the actual structure with which you do that. Are you investing in safes? Are you investing in convertible notes? Are you retaining a third of your portfolio to follow on investments for things that are going well? I think those considerations are like, again, not the most fun.
Yeah, those are
part of
boring
it.
questions to
I
ask.
know. Yeah, they
Nobody
are.
wants
They
to
are.
sit down and ask that. Just read the document.
Yeah, it's not a fun part of the conversation, but I think it's really important. And like the devil's in the details with this particular asset class. And so having capital to double down on the companies that you actually really like and are doing well is what it may or may not save your whole portfolio.
Well, and,
So
and that's why I love these questions so much, because it's like, okay, well, yeah, that's obvious. Like those things should be table stakes, that they have clean, clear answers. But sitting here with someone who is running the behind the scenes portfolio management tracking update thing, anyone who's listening to this, maybe that's a question we should all ask a little bit more often.
I think so. I think that we should all be a little bit more data focused, because the data doesn't lie to you ever. It's kind of hard to parse out. Even like the women's capital breakfast that I was at this morning, the top line number that PitchBook pulls is that 2% of capital is going to female founders. And I'm like, it makes me crazy, because I have been a female founder on the other side of it. And the 2% number, first of all, is like not correct, because that's only female founded teams. That doesn't include mixed gender teams.
Yep.
And that number is closer to like 20%, 25%. And if you look at like the vast majority of companies that are being invested in are tech companies. And I don't know if you've been in an engineering classroom recently. So like, but then on the flip side of that, people say it's a pipeline problem. Well, okay, but are you doing analytics on your pipeline? Because most of you are not. I think people should be more data focused, because I am very data focused, and I would be doing like reporting on if only 10% of our capital is going to founding teams with females on them, is that 10% of my pipeline too, right? Because if that matches, then like, okay, you could make the argument that you need to go source more companies that match these criteria, do your civic duty, right? Your ethical duty, and go find better companies that have more diverse teams. But if that 10% that you're investing in matches the 10% that's applying, I see no problem. So it's just like, there's nuance in the data, and that's what you got asked, but it's always like not that interesting.
No, well, I love it. And I think it's important. And that's the key
I think so.
takeaway here, is if we're trying to allocate capital wisely, make smarter decisions, see what most miss, which this podcast is all about. Most maybe miss some of these obvious questions because they're obvious questions. That's super important. Any other key lessons or key insights that you would share? Final thoughts for our listeners.
Yeah, I think the other thing that I've noted is that it's really hard to nail down a right process, like a right best practices of doing any of this. And I say that because like so concretely, when we built our API to link into the software on the back end, I was considering, okay, do we link in with PitchBook or Crunchbase or Affinity, or like who do we partner with someone directly? And we came to the conclusion, we did a survey of our customers to say, what else are you guys using, right, to track it? And every single person is using something different. You can find trends that a lot of people for deal flow use, like Airtable, or they're using, if they're angel groups, using DLM, or like Affinity for CVCs, but the vast majority of it's all custom text. And so you can find
everybody's homebrewed their own.
They all have yes, and they're all piecing it together, which is great. It's a flexible way to do it, but it's also, you can't really find there's not a lot of standardization. I think now we do have, it's great to have like at the very least, standardized security types. Although I saw a really interesting post on LinkedIn recently about safes and people safe stacking, if you've heard that term yet. It's like, that is wild. As a founder, if I was considering how to scam people out of money, that's something I would consider.
Yeah. Okay, so quick education on safe stacking. What is it? Yeah.
Okay, so safe stacking is where if you're a founder and you think you can scale very quickly, if you take on safe money and then that safe never converts because you never do a price round, you never have to give up any equity. And it's not like a convertible note that you owe them accrued interest via stock or cash or that converts on a certain date. Safes just have an open-ended forever. So if you can raise on a safe and then raise more on a safe and get your revenue to a place you're doing 5-10 million ARR, you all of a sudden have a lovely cash flowing business. You get a cash flow, but then you never have to do anything with it. And you don't have to convert those safes. And I saw it on LinkedIn. I don't know how that post went, but it's also, you could look at it from the standpoint of saying all of the safes that have been issued are now at risk because there's billions of dollars of safes out there and those don't have to convert ever. That's what safe stacking is. Really fun. Well, I think there was a court case too that the investor sued the company on it was something related to a convertible note though, because their note didn't convert and the investor thought that they were worth a lot of money. And then the court said, no, you don't get to force a conversion here. Again, in the details, it's very important.
The terms matter.
Yeah.
Know what most favored nation and pro rata, like know all these things. And that's such a key part of being an educated, informed angel is understanding what these things mean. Maybe not going to the nth degree, but at least having a basic conversational awareness of what these things mean.
Yeah. And I think that's actually a really hard part of angel investing because it's a very new asset class to most people. And then not only do you have multiple hurdles, it's the hurdle of this is like a very risky investment to make. So I have to have quite a bit of money to even want to invest in this asset class. And then from there, it's also, there's a bunch of new terminology that you have to learn and all of those things that are wrapped up in legal documents and they mean a lot to the deal. And so unless you're like, you need counsel and most angel groups and venture funds do have counsel, but as a person, like you're supposed to look for deals you like, look for people you like, do diligence on those deals, and then deploy capital whilst understanding all of the terms in that term sheet.
Can be really overwhelming.
And so, yeah, it's a hard thing to, I think, wrap your head around as somebody who may come from outside the industry and is just learning about it. And I think that's why the angel groups struggle with recruitment and with retention is because it's hard and then you get screwed on one term and that's it.
Which I think is a great reason for angel groups to be a consideration for someone that's listening to this. If you're not a part of a group, consider joining one because they're likely to have or know of resources to help provide some of this education and even just people to tap the shoulder and be like, hey, have you seen this before? Is this right? Is this normal?
Yeah. I wouldn't do this outside of groups. If it were me, like if I was investing in startups, I would not do this outside of a group setting. And there are people that do. We've got 350 individual angels, not enterprise or solo people that are tracking their portfolio. And I don't know why or how. Like you have to be, and maybe they're just like very intelligent people. That's great.
For angels.
But you're going at it solo and then you're deploying capital solo. If angel groups have a hard time getting data as a solo angel and you're not a part of a syndicate or something, you have no insight or legs to stand on. So angel groups all the way.
Love that. So Alycia, thank you for taking the time to join me here. Any last thoughts as we close?
So if you're an investor, an angel, a VC, please track your data. Please just start tracking it. You don't have to use Seraf, use something else. I don't care what you do, but it helps us all if you track your data. And I think that is really, anything in the private markets is really hard to track anyway because you're not mandated, but it's important. And we're like, I think 20, 25 years into angel investing being mainstream, 20 something years since the ACA was founded. And so we should be at a point where we have regular data reporting and we don't have that. And I think that is a little bit broken. So I would just encourage everyone to start both the pipeline and the active portfolio or hire my friend here who does, we can help you with all of this and give you tools to do things. So that's all I would say.
Well, Alycia, thank you for joining us in Denver, Colorado, here at the Angel Capital Association Annual Summit. We'll be here again next year. And so I look forward to meeting many of you then. Alycia, look forward to our next conversation.
Thank you very much.
Thanks for listening to this episode of The Diligent Observer. I'm your host, Andrew, and if you're an angel investor looking for essential angel intel in 5 minutes every week, I think you'd enjoy my newsletter. I send my best stuff, interesting deals, and more straight to your inbox so you never miss a thing. Subscribe today at thediligentobserver.com.